If you don't understand bonds, you don't understand money. There's one simple and boring number that holds the secret to true wealth. You could be broke, running a small business, or a billionaire CEO, and this number will determine how likely you are to get rich. I'm David. I run an air filter company that makes $22 million a month. Before I show you how to use this to get rich, you need to understand what this number actually is and why it controls the price of literally everything you'll ever buy or invest in. It's the foundation of every financial decision made anywhere in the world. How many billionaires get made, how easy it is to start your company, how likely you are to get laid off. A bond is a loan to the government. They pay you a fixed interest rate, say 5% a year, and give you your money back at the end. Since these interest rates are set by the government, they're essentially risk-free. Here's what most people ignore. Bonds set the price of money. If you can get 5% doing absolutely nothing, with zero risk, zero effort, zero drama, then every other investment has to beat that. Otherwise, why are you going to take on more risk? So when bonds pay out a lot, saying 5%, people will take less risk with their money. If I can guarantee a 5% return, why would I risk my money buying a business or stocks where more things could go wrong? Essentially, you're paid to save money. If bond yields are lower, you're paid to spend. You figure out that there's no point in holding this money, it's not going to grow, I should spend it. Then, once spending goes up, company profits go up, stocks go up. Once stocks are up, investors have more money to take bigger risk. This is an oversimplification, but just remember this: bonds are like gravity for money. The lower the bond rate, the more money flies around the economy. So okay, you understand bonds control the economy, but let me show you exactly how this affects your actual bank account. It's boring. But once you understand this number, you'll see why you're struggling. I've read recently that a lot of beauty brands are having trouble this year. Why? Because beauty is something that is a want, not a need. So the first thing to go when interest rates are high, like they are right now, is spending on things like beauty or any business that relies on people's disposable income. The higher the interest rates are, the less disposable income an average person has, and the harder it's going to be to start and run a business. Whereas the lower it is, the easier it is to start a business. But if you're selling something essential, higher bonds will still make your life harder. Think about this. A large portion of HVAC units that are sold are done via financing, which means that the person that's buying it pays for it over time. Well, borrowing money costs more when bond yields are higher, which means investing in those long-term projects gets even more expensive. So even if you're running a boring business like me, if most of your customers need to borrow money to afford you, the demand for you goes down. So what do you do in a high interest rate environment like we're living in right now? You shift your focus from wants to needs. When bonds are high and money gets tight, people don't stop spending, but they do stop spending on anything that feels optional. They prioritize value. They prioritize protection. They prioritize preventing bigger expenses down the road. Lean into value. Make your offer save people money. Extend the life of something that they already own, or prevent a bigger expense later. Also, focus on smaller ticket items. When financing gets expensive, fewer people can afford the big projects, but they can afford smaller fixes and improvements. For example, in the HVAC world, a $10,000 unit replacement gets harder to sell when borrowing costs spike. But a $50 air filter that helps extend the life of that same unit, or a small maintenance job that keeps it running another year, those become easy decisions for customers. In high-rate environments, the winners are the people who help customers protect what they have, not pressure them to buy something new. Here's how you actually use bonds in the real world. Earlier this year, I looked at buying a small filter manufacturing company that was struggling. I understood the business extremely well. I knew exactly how to fix it. And honestly, part of me just didn't like seeing it decay. But when I ran the numbers, even with my knowledge, the return was going to be around 10%. Now, 10% sounds great until you compare it to the risk-free rate, the bond yield, which was about 5%. So I had to ask myself, if I can get 5% doing nothing with zero stress, zero time, zero risk, is an extra 5% really worth the effort, the distraction, the risk, and the opportunity cost of my time? When I looked at it through that lens, the bond lens, the answer was obvious. So I walked away. Not because I couldn't do it, but because bonds told me whether it was worth doing. And that's the power of knowing this number. It protects you from bad deals, bad investments, and bad distractions, even the ones that you're emotionally drawn to. being profitable is overrated. Real millionaires think about something else entirely. Most people look at their business and think that they're winning because they see profit. But there's a trap most people don't see. The more you want to grow, the more money you lose. Let's say I spend $500,000 plus marketing to make some air filters, then sell them for $1 million. After all my cost, I make $300,000 in profit. Sounds great, right? Until you realize I don't have enough money to do it again. If you want to double next year, I'd need another $500,000 of inventory. But I only made $300,000. So now I'm negative cash flow. And that's not even counting taxes. The faster you grow, the less cash you have. You say, I'm making $300,000 a year on $1 million in sales. That sounds great, but you might have a toxic relationship to cash. Avoid the trap of chasing profit while running out of cash, and use bond yields as your baseline to decide whether the growth you're pushing is actually worth the risk. So that's the trap to avoid. But here's what separates people who build real wealth from everyone else. I borrowed $1.2 million and invested another $300,000 of my money to buy a dying industrial supply business in 2012. But how do you go from $300,000 to a multi-$100 million business? You do that by compounding your cash. Compounding is what matters more than anything else. If a business wants to grow, you can't just be profitable, you need to make sure that your cash is compounding. When I turned $300,000 into hundreds of millions of dollars over 12 years, I did that by maintaining a high return on capital year after year. I made sure that anyone who loaned me money would rather bet on me than the easy money in the bond market. Most people think that their competitors are the business down the street, but if you ever need outside money to grow, like banks, lenders, investors, your biggest competitor is the US government. Because if someone can earn guaranteed money in bonds with zero risk, why would they lend to you unless you can beat that return by a wide margin? And that's why the average person needs to understand bonds before they understand entrepreneurship. As a business owner, you're really an investor. Your job is to allocate resources, which is just a fancy term for capital, such as your time, your cash, your team, and then earn a healthy return on those resources. If you can't beat what someone gets in a risk-free bond, you're wasting your time, your energy, and your opportunity. And now that you know the basics, here's how the richest people on earth beat bonds. The specific characteristics that let some people get access to money. The secret to higher returns isn't working harder, it's building once, selling forever. Software is a popular business because you build a system. And then, the more people you sell to, the cost doesn't go up. If you sell software to one person, it doesn't cost meaningfully more to sell it to 100. Your marginal cost increase is very small. You've already spent the money on the software, the engineering team, the back end, so now you just need to sell it over and over again. But how do you implement this in a boring business? There's this guy who built a system around how to start a junk business, then sold that system and replicated it through franchising. So instead of compounding by spending on more employees and trucks, he sold his knowledge and brand. That's the reason I talk about systems so much. It's a way to compound your knowledge into a very high return on invested capital. There are lots of things about FilterByte's business model that make it capital light, meaning relatively cheap to run, which allows a very high return on investment and return on capital. And that's the secret to why I've been able to scale it. To consistently beat the bond market, meaning to earn returns higher than the risk-free rate, you need 4 things. These are the 4 filters that the richest people in the world use before they ever invest their time or their capital. Number 1, durable moats. You need something that protects your business from competition. A brand, a unique process, geography, reputation, relationships, anything that makes you hard to copy. Bonds are risk-free, so if you want someone to choose you over bonds, you better have a business that isn't easy to attack or replicate. The second thing you need is pricing power. You need the ability to raise prices without losing customers. Because when inflation hits, or costs go up, or bond yields rise, businesses with real pricing power keep compounding. It can be the difference between selling a product and being essential. The third thing you need is low capital intensity. And this is a big one to me, and I think it's often overlooked. If every dollar of growth requires another dollar of investment, you will never meaningfully outrun the risk-free rate. The best businesses are capital light. Things like knowledge, systems, intellectual property, and brand. Things you build once and then can sell forever. That's how you beat bonds. And fourth, trustworthy capital allocation. You can have a great business, but if you make dumb decisions with the cash that it generates, you're gonna lose. Wealthy people obsess over what they do with the cash that they generate, where it flows, what gets reinvested, what gets protected, and what gets returned and spent. Outperforming bonds requires discipline. Every dollar that you deploy needs a purpose, a timeline, and an expected return. Those four things, moats, pricing power, low capital intensity, and disciplined capital allocation, are the only consistent way to beat the bond market over decades. It's not luck, it's not talent, it's understanding that your biggest competitor is risk-free money and building something that can outperform it year after year. If you own a boring business doing at least $1 million in revenue and you want to take it to the next level, I want to hear from you. We're filming in New York, Miami, and Las Vegas, travel covered. Email the address on the screen with a bit about your business. I look forward to learning about your business in person soon. If you like this video, watch my video on buying a business for $0 here.